The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. My name is Pam Pfeiffer, and I'm the Training Director for REMN Wholesale. I want to thank everyone for taking time from your busy schedules to join REMN Wholesale's first installment in their Integrated Disclosure webinar series. This presentation and this recording will be distributed after the webinar is over. At this time, I'd like to ask a couple of poll questions to find out exactly who we have here today. So if everyone can, please. I've just launched my first poll question, and we want to know who has joined us today. And we're going to take about 15 to 20 seconds before we close out the poll. And I'm already seeing more people joining us, so please, everyone who just joined in the last 30, 40 seconds, if you can, please. Okay, we still have some people answering. Great, it looks like we have a good mix of people. So I'm going to close here. And I'm going to go to our next poll question, which is, how familiar are you with the Integrated Disclosures rule? And if everyone can just take a couple seconds to please answer this poll. Okay, I'm going to close out this poll too. And I'm going to share the results with everyone. So you can see we have somewhat of a mix that some people say they are somewhat familiar, and some people, the exact same amount, said this is all new to me. So this is a good mix of people. Okay, so without further ado, I'd like to introduce Carl Markman, who is our Director of National Sales for REMN Wholesale. Carl?
Thank you very much, Pam, and welcome everyone to today's call. As I travel across the country, I speak to a lot of individuals in our business, and the poll question that Pam just put up is not indicative of what I'm finding out from people in our industry. Most are not familiar with what's about to change on August 1st of this year, and so we felt it imperative that we are one of the companies out there that educates as many people as possible. So we have a series of these presentations over the next several months until August 1st, so please make sure that everyone signs up for these. But without further ado, again, welcome everyone to this webinar, and I'd like to introduce Phil Schild, our General Counsel and Chief Compliance Officer. Phil, you there?
Yes, I am, Carl. Thanks.
Thank you.
Thanks, everybody, and once again, thanks for joining this webinar. The goal really is to provide an overview for you of the Killer RESPA Integrated Disclosures Rule, which goes into effect August 1st, 2015. As mentioned in the poll question, you know, the education and the knowledge out there is pretty wide and varied, and I want to emphasize here that this is the first of many series, and we are going to really touch on the basics and the overview today, and then at the end we'll do some Q&A as well. So first off, fundamental mortgage lending disclosures have been in place for more than 30 years are changing. The CFPB finalized amendments to Reg X, RESPA, and Reg Z TILA that integrate existing disclosures, and they take effect beginning with applications received on or after August 1st, 2015. The first thing that we're going to all need to do as an industry is start learning the new terms for these disclosures. So first we have the loan estimate, or LE, which combines the initial truth in lending disclosure and the RESPA GFE. Then we have the new closing disclosure, or CD, which combines the final truth in lending disclosure and the HUD-1. I want to also emphasize that while we're going to focus on the disclosures today, these changes are not just about two new disclosures. There are fundamental workflow changes, particularly when it comes to closing. So the slides that are going to follow are an overview of the new disclosures, and we're also going to talk a little bit about comparisons to business today versus what business will be like starting in August of 2015. Next slide, please. First thing we want to talk about is that the application definition that we're used to using for the last 4+ years is going to be changing. As it is today, application is 7 items. And what will start happening with August 1st is that there are now going to be only 6 items that define an application, and those 6 items are universal, which means that the definition of an application across all lenders, brokers, mortgage bankers is going to be the same. The 7th item, which is the lender discretion item, has been removed from the definition of an application, which means that an application is considered complete for disclosure purposes when the 6 items above are provided, and then that will trigger the requirement for issuing a loan estimate. Next slide, please. Some basics about the loan estimate. And once again, this document will combine the GFE and the initial TIL. The goal is to provide a consumer with a good faith estimate of the credit cost and the transaction terms. It has to be in writing like we're used to today. And some of the basic information that's required are the things that you're used to seeing on either a GFE or a TIL, such as applicant information, property loan, rate lock status, loan terms, projected payments during the term of the loan, the cost of closing, the total estimated closing cost, and estimated cash to close. The loan estimate, page 2, has the actual specific fees, other costs, calculation of cash to close, and there are sections that appear when we have adjustable rate mortgages, whether it be an adjustable interest rate or an adjustable payment. The 3rd page has other information, some of which we're used to seeing, and there's also some new disclosures that replace existing disclosures. So we can go to the next slide. So most of the information on the GFE and the TIL is going to be presented on the loan estimate. The format is drastically different than what we're used to seeing. The information that is in the eyes of the CFPB and the consumer studies most helpful to consumers will appear on page 1. This includes information that is either required by the Dodd-Frank Act or based on market studies was deemed as being important in the eyes of consumers. The cost can be itemized, but each category is subtotaled. One of the things we like to note early in this discussion is that the APR, which is front and center on it till now, ends up being on page 3 of the loan estimate. There was also a new figure called the total interest percentage, or TIP, and this is disclosed on page 3. This is the total amount of interest that the borrower will pay over the loan term as a percentage of the loan amount. In our little visual here, that's the 3rd entry there. Also, I'd like to mention that the loan estimate has a place for the borrower to sign and the consumer to sign to confirm receipt. However, this does not indicate intent to proceed. So just as we are used to today, having to deal with GFEs, that a separate intent to proceed is required. We cannot tell you why CFPB didn't make this the intent to proceed, but for purposes that I can't explain, we are still going to require a separate intent. Also like to mention that certain information that we're used to seeing on the TIL, for instance, or the GFE is no longer part of the upfront disclosure, such as the finance charge and approximate cost of funds. Figures like that were deemed to be confusing to consumers, and therefore they were removed altogether from the upfront disclosure. Next slide, please. I want to talk a little bit now about delivery of the loan estimate. This is similar to what we're used to when we have to deliver an upfront GFE or a TIL, but the thing that's important is that it's combined. So there's only one disclosure that's being issued up front, as opposed to today, especially in TPO business, where commonly you'll have a broker issuing the GFE, and then when a file is received by a lender or a wholesaler, then a TIL gets issued. That's changed here because we have only one document, and the timing applies to that single document. So the creditor must deliver or place the loan estimate in the mail not later than the 3rd business day after the creditor receives the consumer's application. Once again, similar to today. If the loan estimate is not provided to the consumer in person, the consumer is considered to have received it 3 business days after it is delivered or placed in the mail. That's the mailbox rule, and once again, that is the same as it is today. For purposes of providing the loan estimate, a general business day is a day on which the creditor's offices are open to the public for carrying out substantially all of its business functions. You'll hear this also known as a open for business day. And that's the same thing as it is today, which is that once an application is received, you have 3 days to issue that loan estimate, 3 days based on when we are open for business. The bottom of the slide here is just reiterating that the application definition has been updated, and it's just 6 items. Next slide, please. I want to talk about pre-disclosure and charging of fees. Some of these concepts are very similar to what we're used to today that were introduced back in 2009 with MDIA and in 2010 with the RESPA changes. First and foremost, no fees may be imposed on a consumer in connection with the application before the consumer has received the loan estimate and indicated to the creditor an intent to proceed with the transaction. In addition, no payment information may be requested or held until intent to proceed is provided. And what that means is, at the point of an application being taken, anybody cannot collect information about fees. You cannot collect a check. You cannot collect credit card information until the borrower has received their loan estimate and indicated intent to proceed. And that is a change from what most of us are used to today. The exception to the fee imposition is that, and similar to today, a bona fide and reasonable fee for obtaining a credit report can be charged in advance of issuing the loan estimate and the borrower indicating intent to proceed. So the next bullet talks about pre-disclosure. So if a consumer is provided with a written estimate of terms or costs before receiving the loan estimate, certain specific requirements must be satisfied. And the point with this is that we know at point of sale it's very common for MLOs to provide consumers with closing cost estimates, pre-closing worksheets, various types of forms that are used out there for borrowers to shop, for them to have an idea of comparisons across different companies when it comes to doing their application. That is still allowed. However, the CFPB within this rule has come out with very specific requirements. We won't get into the details today, but the point is you can still do that as part of your normal workflow. However, it has to be very clear to the borrower that they're not receiving a loan estimate and that they have to get a loan estimate within the 3 days of their application. Last bullet here is that we may not require, can you go back 1 second, thanks. We may not require a consumer to submit documents verifying information related to the application before providing the loan estimate. And what that means is that once we have 6 items, we have an application. At that point, we have to issue the loan estimate. We can't condition issuing that loan estimate based on verifying anything. We can't ask for a pay stub or a W-2 or a bank statement prior to issuing the loan estimate. Once we have 6 items, LE is triggered. Thanks, Ben. So we're going to talk a little bit now about the concept of good faith as it relates to the loan estimate. We've used the term good faith estimate for a long time, and I think as an industry we pretty much understand it. However, CFPB has kind of tweaked this definition a little bit. And the key here is that a loan estimate figures must be made in good faith and consistent with the best information reasonably available to the creditor at the time disclosed. And if we think about that practically speaking, today when a GFE is issued, we do certain things to try to give borrowers an estimate of those fees, especially fees that don't relate to origination per se, third-party fees, title, settlement, taxes, other types of things that we don't know. The burden here now on anybody issuing a loan estimate is that we've used the best information available. And that's hard to necessarily define, but we will have a burden of making sure that we have reasonable systems in place to give borrowers the best possible estimates of these fees up front. So how do we determine good faith? We look at the difference between the estimated charges originally provided in the loan estimate and the actual charges paid by or imposed on the consumer at closing. Generally, if the charge paid by or imposed on the consumer exceeds the amount originally disclosed on the loan estimate, it is not in good faith. There are exceptions to this, and we'll discuss tolerances and so forth later on. But this idea of good faith is true regardless of whether the creditor later discovers a technical error, a miscalculation, or an underestimation of a charge. So basically what we're used to since 2010 with GFEs with no whoopsies or I'm sorry, I missed it and so forth, that still applies, but there is definitely a heavier burden on making sure that we've done the best job possible up front. Next slide, please. So we're going to talk now a little bit about tolerances and variances. Once again, concepts that were introduced back in 2010. And they're very similar to what we're used to today. We have zero tolerance 10% cumulative tolerance, and no tolerance fees, just like we're used to today. You'll see when you get into these documents that the concept of tolerance has a lot to do with how the forms are laid out, how various fees are grouped together on these documents, and then ultimately how the determination is made whether or not we have a tolerance violation and whether it was acceptable and so forth. So once again, don't want to spend a lot of time on this because this is a concept that is used to that we're used to dealing with. Just wanted to point out that in the zero tolerance section, fees paid to an unaffiliated third party if the creditor did not permit the consumer to shop are now in zero tolerance, and that's new. The rest of the categories are very similar to what we're used to. We still have to produce to the borrower a written list of service providers. We still have to determine whether or not the borrower shopped on their own. Did they pick a provider off of the list? And that affects tolerance. And it also affects actually placement on the documents. When we get into the closing disclosure, you'll see that the categories on the closing disclosure are totally dependent on whether or not the borrower did or did not shop for a specific service. Next slide, please. So it's inevitable that we are going to need to make corrections and revisions to these documents, especially to the loan estimate. We'll talk about how that works. As a general rule, creditors are bound by the loan estimate and may not issue revisions because they later discover technical errors, miscalculations, or underestimations of charges. Creditors may only charge more than the amount disclosed when the original estimate or lack thereof was based on the best information reasonably available at the time of the disclosure. And as we are used to today with the GFE and changed circumstances, you can issue or we can issue a revised loan estimate in certain specific circumstances, such as a changed circumstance that occur after the loan estimate is provided to the consumer that cause settlement charges to increase more than permitted. Changed circumstances that occur after the loan estimate is provided to the consumer that affect the consumer's eligibility for the terms in which the consumer applied or the value of the security of the loan. And an example of that would be if the LTV changed on the transaction, and because of that, mortgage insurance is either added or it's changing, and as a result, the fees increase. Or if we went from conventional to a government loan and so forth, and now we have MIP added, and because of that, that's a valid change like it is today. If a borrower requests a change, if a borrower requests a different LTV, different program, some other variable that changes here, that is also a valid change of circumstance. Just as we're used to today, the act of locking an interest rate is also a valid change of circumstance. And also, we're used today, if the consumer indicates an intent to proceed with the transaction more than 10 business days after the loan estimate was originally provided, then we are allowed to change the terms. And that is the same as it is today coming out of the GFE regime from 2010. There's also, if in the case of a new construction loan, there's some rules about disclosing upfront to the consumer. In the case of new construction, that fees may be subject to change because of the amount of time elapsed in the transaction. Next slide, please. So change circumstance. Once again, very similar to what we're used to from GFEs. A change circumstance for purposes of revising the loan estimate is an extraordinary event beyond the control of any interested party or other unexpected event specific to the consumer or transaction. This is information specific to the consumer or transaction that the creditor relied upon when providing the loan estimate and that was inaccurate or changed after the disclosures were provided, or new information specific to the consumer or transaction that the creditor did not rely on when providing the loan estimate. For example, a changed circumstance may be war, natural disaster, or unexpected event specific to the consumer or the transaction, such as a loss of employment. Next slide, please. I want to close up the discussion on the loan estimate with some additional notes. The first is the creditor is required to deliver or place in the mail the revised loan estimate within 3 general business days of a changed circumstance. That also includes the interest rate being locked. or specifically when a lock agreement is executed by the creditor. If a mortgage broker receives a consumer's application, either the creditor or the mortgage broker may provide a consumer with the loan estimate. If a mortgage broker provides the loan estimate, the creditor is still responsible for compliance. More information regarding these workflow considerations will be addressed in the future webinars, because today there are some differences in the industry how that is handled when it comes to GFEs and also TILs. Generally speaking, the responsibility of the TIL today lies with the lender, and in most cases, practically speaking, the GFE is being issued by the broker. The nuances of this are something that are not spelled out very well, frankly, within the regulations and the guidance from the CFPB. And there are other areas that we'll discuss where how the TPO lending industry is going to respond and come up with workflow still needs to be dealt with. So wanted to mention that here. Also, in closing on the LE, an alternative loan estimate may be used if the transaction does not have a seller. So for refinances, there is a LE that's modified for that specific purpose. The last thing, which is going to be critical as we move closer to August, is that creditors will still be required to use the current GFE, HUD-1, and Truth in Lending forms for applications received prior to August 1st, 2015. As those applications received prior to August 1st are closed, withdrawn, or canceled, the use of the GFE, HUD-1, and Truth in Lending forms will no longer be used for most mortgages. We say most mortgages is because reverse mortgages and HELOCs are still going to be using the standard RESPA forms today, GFEs, TILs, and HUD-1s. Most of the transactions that we cover will be transitioning to the LE and the CD. But this is critical. There is a very clear line of demarcation about when you use existing versus when you use new. So transactions that are in process prior to August 1st will use those existing forms all the way, even if it takes them a year to close. And everything that's originated, application received starting on August 1st, will use the new forms. Next slide, please. Now we're going to move into an overview of the other new form, the closing disclosure. So once again, closing disclosure combines the final TIL and the HUD-1. The closing disclosure must generally contain the actual terms and cost of the transaction. It's spelled out in the code section there. Basic ideas here. Page 1 is general information, loan terms, projected payments, and cost of closing. Page 2 is very similar to page 2 of the existing HUD-1. It's the breakdown of the fees. Page 3 has cash to close and other summaries. Page 4 has additional information, additional disclosures that are there, information about escrows and adjustable rate and payment tables when applicable. Then page 5 has other information, calculations. Some of the TIL calculations are on page 5. Other new disclosures that are there, contact information from all the parties in the transaction, and also a place to confirm receipt. Wanted to note that an alternative closing disclosure may be used if the transaction doesn't have a seller. So similar to today when there is an alternative version of the HUD-1 for refinances, there is an alternative version of the closing disclosure. Next slide, please. So I do a little comparison here of some of the items from what we're used to today. Once again, very similar information than what we're used to today, but the presentation is very, very different. Page 1 of the closing disclosure is pretty much a mirror of page 1 of the loan estimate, and it doesn't look anything like a TIL or anything like the HUD-1. The costs are itemized with columns indicating the party and the timing of the payment. You'll see that on page 2, while there is a columnar structure, it's very different than what we're used to today. There's an additional information on page 3, the page 3 HUD-1 comparison column, which has caused a lot of confusion for the last 4+ years, has been replaced with the calculation of cash to close. The federal box disclosures are on page 5. So once again, items that are forefront on a TIL today, page 1 right in the middle, top of a TIL, have been moved to page 5 of the closing disclosure. There's some additional information there as well. I wanted to reiterate once again that we have this clear line of demarcation for when we will use existing disclosures and when we will use the new disclosures. Every loan taken August 1st going forward, where an LE is issued, has a corresponding closing disclosure. You'll never mix and match between the two. Next slide, please. This slide is probably the one that should be in red if we were going to have one, because of all the timing things that we've talked about so far are very, very similar to what we're used to today with GFEs and TILs and so forth. The timing requirements of the closing disclosure are by far the biggest impact in workflow with the new rules. So a creditor is responsible for ensuring that the consumer or the borrower receives the closing disclosure no later than 3 specific business days before consummation, also closing. The term consummation is used throughout the regs. In most cases, it means closing. And the term consumer is used all over the place too, but for our purposes, we'll just call that a borrower. So for the purposes of delivering the closing disclosure, a business day means all calendar days except Sundays and legal public holidays. Once again, this timing requirement is new, and it will impact the scheduling of all closings. If the closing disclosure is not provided to the consumer in person, the consumer is considered to have received it 3 business days after it is delivered or placed in the mail. Additional information regarding electronic delivery will follow, because our expectation is that all the disclosure going forward, when possible, will be done electronically, whether it be on the upfront side for the LE and on the closing side for the CD. Rule 3 is a very big workflow discussion, which is that a creditor may contract with a settlement agent to provide the closing disclosure on the creditor's behalf. However, in this case, the creditor is still legally responsible for the accuracy as well as any errors or defects. That is very different than what we're used to today. What we're used to today is that the settlement agent, closing attorney, whoever's preparing the HUD-1 is ultimately responsible. But in August 1st going forward, the creditor or lender is responsible. Wanted to mention here that consummation is defined under Reg Z as the time that a consumer becomes contractually obligated on a credit transaction, which is the date that the note is signed. Also wanted to mention at the very end that the settlement agent must provide the seller with the closing disclosure. And what you'll notice when you look at a closing disclosure is there is nowhere for the seller to sign it. There is no addendum like we have, an addendum to a HUD-1 where both parties sign it. This kind of new world is really focused on the borrower/consumer side of this, and our responsibilities in the lending community are all to the borrower. So definitely some changes there, and there's going to be a lot of adjustment, when we set up closings and so forth, and the dynamics between buyer representation and seller representation and so forth. Next slide, please. Talk a little bit about revisions and corrections, because this ties into the other concept of timing, and there has been some misinformation about the timing requirements when we have to issue a revised closing disclosure. So as a general rule, creditors must redisclose terms or costs on the closing disclosure if certain changes occur to the transaction that cause the disclosures to become inaccurate. There are 3 categories of changes that require a corrected closing disclosure. Okay? I want to say that again. There's only 3 categories. For a while, there was the perception that if anything changed, that we had to reissue the closing disclosure and then wait another 3 days. There are only 3 triggering events. They're listed below that require a new 3 business day waiting period. If the APR becomes inaccurate, if the loan product changes, or if a prepayment penalty is added. Loan products, for the purposes of this discussion, means a fixed rate versus an ARM or a type of ARM. So if somebody goes from a fixed rate to an ARM at the very end after a closing disclosure has already been issued, then a new closing disclosure will have to be issued in a new 3-day waiting period. There are other changes that occur after the closing disclosure has been issued that do not require a waiting period. They will require a regenerated document and making sure that the borrower signs a 100% accurate document at closing, but there's no additional 3-day waiting period. There are also changes that occur after consummation or closing that require issuance of a new CD. Just as it is today, the consumer has the right to inspect a revised closing disclosure during the business day before consummation. That's the way it is today with a HUD-1, though many consumers don't take advantage of that right. Next slide, please. I want to briefly talk about tolerance violations and cures, something that we deal with once again every day today. Want to mention that when you get into understanding the dynamics of the closing disclosure, you'll see that the columns where the tolerances are calculated doesn't exist anymore. So the form is dynamic. It does display what the original fee disclosure was versus what's being paid at closing. There are calculations that are done there, but there's definitely going to need to be time and energy spent on understanding how to identify cures, and then the timing associated with that. So basically, if the amounts paid by the consumer at closing exceed the amounts disclosed on the loan estimate beyond the applicable tolerance threshold, the creditor must refund the excess to the consumer no later than 60 days after consummation, and the creditor must deliver or place in the mail a corrected closing disclosure that reflects the refund no later than 60 days. So if there is a tolerance issue and it's not identified at closing, or the identification is such that a new closing disclosure cannot be prepared in time, that's okay. We can still reissue a revised closing disclosure after the fact. We can handle a cure after the fact. And at the end of the day, we always have to make sure that when it's all said and done, the consumer gets a 100% accurate representation of the fees. For zero tolerance charges, any amount charged beyond the amount disclosed on a loan estimate must be refunded to the consumer. That's the way it is today. And the same thing with the 10% cumulative tolerance charges. Next slide, please. So talk about what's next. First of all, as I stated when I started 30 minutes ago, this is a general overview. We covered a lot of material in a short amount of time, and there's going to be a lot more material that we'll be working to get out to you. These changes are not just about two-note disclosures. There are significant impacts on timing, delivery, workflow, policies, and procedures. And throughout the process, we will be seeking input from our broker partners. Every day that we talk about this and every day that we learn about this, we realize that there are more questions, there are more discussion topics, and there's a lot of nuances in the details of how our lives will all be in August and going forward. I wanted to mention that the integrated disclosures rule is enormous. Almost 1,900 pages of actual regulations, 400 plus changes, over 1,100 business rules associated with these dynamic forms, and over 362 data elements within your systems. So there's a lot going on there. And next slide, please. Wanted to mention, in closing for me, is that there's a lot of information out there right now. The CFPB implementation page is a great resource. There are a number of examples of the disclosures. There are numerous guides. It's in plain English. It's pretty transparent, and we think it's a great resource for you to help get educated. As part of that, we've provided samples of the loan estimate and the closing disclosure, just 2 samples. There are numerous samples on the CFP website, including different types of loan programs, some versions that are blank, some that are filled in. And once again, I think it's a great resource to continue with your education. And I think I'm going to turn it over to Carl or Pam.
It's going to be me. It's Pam. So as Phil and Carl stated, we are going to bring you more webinars to you. The next one is going to be March 18th at 3 o'clock. And it's going to be part 2 of the 6-part series, What's Different with Integrated Disclosures. Before we leave, though, I am receiving a lot of questions, and unfortunately we're not going to be able to get to all these questions, but we're going to have a short Q&A with Phil based on some of the questions that you as the audience have written in. So starting with the first one, so who's going to be responsible for issuing the closing disclosure? Is it going to be the closing agent, or is it going to be the lender?
Okay, Pam, that was one of the items that we did mention on the slide, is that at the end of the day, the lender is responsible for this document. The lender can contract with a closing agent to issue or collaborate together on issuing it, but at the end of the day, when it's all said and done, it is the lender's responsibility.
Great, thank you. When the final HUD-1 is provided 3 days prior to closing, will it mirror the 3-day rescission period and include holidays and weekends?
Okay, good question. So the first thing is that there's no final HUD-1 after August. So for the purposes of discussion, getting used to it, it's the closing disclosure. And the specific business day rule is similar to rescission, all days except for Sundays and certain federal holidays.
Great, thank you. Another question came in, does the broker compensation have to be disclosed as it currently does right now in box number 1 on the GFE?
Okay, so the layout of the loan estimate is very different than a GFE. There's no more block 1 and block A and so forth that we're used to today. So the answer is that the form is different, but also lender paid compensation is not issued on the loan estimate. It's not, does not appear there at all. There's no place for it and there's no requirement for it. Broker compensation or lender paid compensation will appear on the closing disclosure. So that's the answer to that one.
Great. And how will the role of the broker change?
I think that, as you can see from this webinar, broker specifically were only mentioned a couple of times. And that's because that's the way the rule really sits, that most of the emphasis in the rule and the explanations revolves around the creditor's responsibility. And a lot of what has changed is that while a creditor may allow a broker to do certain things like issue a loan estimate, or a creditor or lender may accept a loan estimate issued by a broker, at the end of the day, the lender is still responsible for it. So while the relationship is going to be very similar, there are some slight changes because of the responsibilities that the rule sets forth.
Great, thank you. And how much of this rule will affect the settlement agent?
I think it's going to affect the settlement agents dramatically. And that's because, first of all, once again, they have to learn a new disclosure. So once again, no more HUD-1s. The new disclosure is going to be different. Also, the relationship between lenders and settlement agents is going to change because of the responsibility shift. So because the obligations and the ultimate responsibility for accuracy of the closing disclosure sits with the creditor, what a creditor is going to require of a settlement agent is going to be changed because of the differences in responsibility.
Great. So how can a mortgage broker or MLO complete the pre-approval process with a full documentation from the borrower?
I think the best answer is carefully. And I say that because, remember, one of the introductory slides to this deck talked about the definition of an application and triggering the requirement for issuing that loan estimate. So if within that pre-approval process, a broker collects those 6 pieces of information, at that point, that triggers the requirement for issuing a loan estimate. And there's no wiggle room because there's no 7th item. So yes, pre-approvals are still going to be allowed. The rule doesn't say you can't do pre-approvals anymore. And as I mentioned before, upfront fee estimates are still going to be allowed and so forth. There are some specific rules about that. But whoever is speaking to a borrower up front has to be very, very careful about triggering those 6 items and unintentionally, being in a position where they have to issue a loan estimate, even though they may not be prepared to do that at that point.
Okay. Well, I guess this is sort of a follow-up question then. Who issues the GFE, and how can MLOs give estimates to clients before application?
Once again, GFE is being replaced with the loan estimate, and we did have a slide in there that talked about that. The first mentioning that says that a creditor may allow a broker to issue it on their behalf, but at the end of the day, the creditor is still responsible for the content. So it's similar to what we have today, where many lenders accept GFEs and from brokers, and as long as they meet those minimum standard requirements, they accept the loans and loans move forward from there. So we're still working that out, and I think industry is still working that out, the dynamics from the standpoint of a broker issuing that upfront LE.
Great. So how does this rule affect purchases versus refinances?
The main difference is that there are different versions of the forms, as I mentioned here. There's a refinance version of the loan estimate. There's a refinance version of the closing disclosure. But the timing rules that we talked about, which are issuing the LE within 3 days, change of circumstance, issuing a closing disclosure 3 days prior to closing, those are all the same regardless of whether it's a purchase or a refinance.
Great. So I'm going to go to our final question that we have time for today, and someone actually asked, Why are the rules, why do they keep changing on us?
We could probably spend days or weeks talking about that. I think the simple answer is if you look at some of the commentary from the CFPB about this, the real goal here was for these complicated transactions to be as easy as possible for a consumer, a regular consumer, to understand. And Dodd-Frank mandated this. The method in which the CFPB came about creating these documents was based on, from what I understand, pretty extensive market research, with consumers, with consumer advocacy groups and so forth, to try to, at the end of the day, make the process as easy from an understanding standpoint to the consumer as possible. And I also think at the end of the day, once the industry is transitioned, the end result will be that consumers will have less questions after the fact, less issues. They'll have a better understanding of their transactions, not only at closing, but before they go to closing. And ultimately, it will be smoother transactions. But I also think it's going to take a while for the industry at large to adjust to that.
Great. Thank you so much, Phil, today for your time. Carl, are you still with us?
I am. And Phil and Pam, thank you so much for helping us understand this a little bit better today. We all felt that it was very important to make sure that we gave an overview today. So I hope that everyone felt that that this was in-depth enough. This is only part one in the series of 6 presentations over the next several months. Next presentation, like Pam had mentioned, is on March 18th. Who we're going to have present that is Ben Olson. And Ben is a partner of Buckley Sandler in Washington, D.C., and he's actually participated in the writing of these rules. So I would urge all of you to sign up soon because space is limited for this next webinar, and sign up today to make sure that you get on there, and we'll be sending out that link as well. Again, thank you everyone for attending today's webinar, and I think you all realize that, and if you didn't before today's presentation, our world is about to change significantly again on August 1st, and it's imperative that all of us understand all of these changes before it happens. And REMN Wholesale is dedicated to making sure that we are your partners and making sure that we're your resource in educating as many people as possible. So again, thank you very much for attending, and please make sure you sign up for our next webinar scheduled for March 18th. Thank you very much, everyone. Have a terrific day. Bye-bye.